Hello and a warm welcome. I'm Sam, a financial advisor and head of growth at Vega. Vega are Bailey's preferred financial solutions provider, helping in the mortgage, business, commercial, and insurance space. We acknowledge it's been a year full of constant change, and it's timely to share some thoughts and insights into what we're seeing currently in the mortgage environment. You've no doubt heard of many changes in the property market, as it really has been a hot topic. So I thought I'd give you a bit of a snapshot from our perspective and mention some of the things that we've been seeing. In general, we have seen banks adjusting lending policies to ensure that they accurately understand people's financial position. This really includes taking a microscopic lens at all income sources and expenses, including liabilities, and some even going to the point of implementing the use of debt to income ratios. This rapid tightening of bank lending standards has also meant the availability of credit has been reduced in the past few weeks or so. And to be honest, it's likely to come as well. So what have been the major changes we've seen in 2021? Well, we've seen the rise in mortgage interest rates, actually probably more rapidly than we anticipated. We've also seen tighter loan to value ratio rules, and this has been from the beginning of the year to more recently as well. If you recall, at the very beginning of the pandemic back in 2020, the Reserve Banks actually loosened those rules. But now, as part of their toolkit, they've implemented 40% deposit requirements for investors, for example. There's also been reduced availability of credit for those with less than 20% deposit. So it's getting a little bit harder as they bring these rules back into place. We've also seen changes to interest deductibility rules, primarily impacting investors, whereby it technically makes it more expensive for an investor to own an investment property. And in general, we've seen tighter lending policy from the banks, which has kind of been ahead of the changes of the Credit Contracts and Consumer Finance Act. Bit of a mouthful there, but we technically call this the Triple CFA. This has come into play and essentially takes a more stringent approach to your situation, which we're seeing cause a reduced loan approval rate as essentially it means the bank's benchmarks for approval are more stringent. The Reserve Bank recently also enforced banks to have no more than 10% deposit of new lending to those with less than 20% deposit. We've seen a surge of applications with applicants where they've got less than 20% deposit and their existing approvals are not being extended. So it really limits their options. There are exemptions around this, and this is in the new build space as well. So that's quite separate criteria. Some other changes that we see that could lie ahead, again, is where the Reserve Bank have some of these measures in their toolbox. The introduction of debt to income ratios. We're seeing this really limit people's lending. You can have all the equity in the world, but essentially, unless you meet that debt to income ratio threshold that the banks may implement, you won't be able to get your lending, or you may not be able to get the lending that you require. So we have seen a couple of banks already implement this proactively, and that's BNZ and ASB at this time. We're looking at a benchmark around 6 times, 7 times debt to income ratio, and again, splitting it out amongst owner occupiers and investors as well. There's also consultation on the further removal of tax deductibility for investors. For more detail on this, I'd probably suggest consulting your accountant. And there were changes that happened earlier on in this year as well. We anticipate further interest rate increases as well. Obviously, we've been in a rising interest rate environment at the moment over the past few months or so, and we've really seen rates go up approximately 1.5%, more so than they were 6 months ago. We anticipate seeing that this rise continues above current levels as well. And although we do remain in uncertain times because of this new COVID variant making an appearance overseas. So there's still a bit of water to go under the bridge there. As you can see, there are a variety of changes that widely impact potential purchases, and there's potentially still more to come. And also these impacts are obviously impacting those looking to buy and sell. Our financial advisors have access to many lenders and can help navigate to reach the maximized potential. We get asked a lot, what if my bank says no? Well, all banks are different in their assessment. Their outputs for every situation can be very different at times. We deal across about 50 plus lenders in the main bank space, non-bank space. So we do actually have the capability to source options. The non-bank lenders at the moment are accounting for about 1.4% of total home lending as a percentage of total home lending in the market. This is probably looking to increase as people look for alternative options. At this point, as you can understand, we're in a more stringent period. So I would suggest really utilising your resources and surround yourself with all of the professional services you can. This will just obviously help you make an informed decision whether you look to buy, sell, whatever it may be. And that includes mortgage advice, insurance advice, solicitors, and obviously, of course, your real estate agent. So hopefully this is of some value to you. That's it from me. All the best nearing the end of 2021 and all the best for the year of 2022. Thanks.